All right, everyone, buckle up because you're tuned into Qualcomm Pulse, and the news cycle is absolutely on fire. We're diving headfirst into a whirlwind of updates that you do not want to miss. From seismic shifts in global economics to the cutting edge of technological innovation, we've got it all, and we're breaking it down faster than you can refresh your feed. Get ready for insights that could reshape your understanding of the world and the industries that drive it. This is where the pulse of progress beats strongest, so let's get straight to it. First up, a move by the U.S. government has sparked a fierce debate about the future of national investment and corporate oversight. We're talking about a significant equity stake in a major tech company, a decision that's raising eyebrows and prompting urgent questions about market distortions and potential conflicts of interest. Is this a revolutionary step towards a new era of national economic strategy or a dangerous precedent? We'll explore the arguments and the implications. Then, we're shifting gears to the heart of the tech world, where the semiconductor industry is hotter than ever. Analysts are weighing in on the major players, dissecting their strategies and picking the frontrunners for the future. Who's leading the pack in the AI chip race, and what does it mean for investors and the broader tech landscape? Get ready for some high-stakes analysis. We're also looking at a surprising development involving a prominent politician's reaction to a major tech deal, a stance that's creating ripples and adding another layer of complexity to an already intricate situation. What does this mean for the company, the government, and the public perception? Finally, we're diving deep into the strategic maneuvers of a tech giant as it navigates a critical turnaround. With new leadership at the helm, the question on everyone's mind is this the moment to bet on their resurgence? We'll examine the performance, the investments, and the analyst outlook to see if this company is poised for a comeback. Stick around, because this is your essential briefing on what's moving the markets and shaping our future. Don't forget to like this video, subscribe to Qualcomm Pulse, and hit that notification bell so you never miss an update. Let's go. A calculated risk or a fiscal folly, the Intel equity stake debate. The U.S. government's recent acquisition of an equity stake in Intel, announced with fanfare by President Trump, has ignited a firestorm of debate among economists and policymakers. While the administration touted the move as a zero-cost taxpayer gain on an $11 billion asset, a closer examination reveals a more complex financial picture. The reality is that this decision was underpinned by approximately $8.9 billion in subsidies, with the potential for further financial commitments down the line. This strategic maneuver, portraying a substantial government handout as a shrewd investment, has led some observers to speculate that it could be the nascent stage of a broader U.S. sovereign wealth fund. This development has drawn sharp criticism from various corners of the economic spectrum. Economists, both conservative and liberal, have voiced significant concerns. The core of their apprehension lies in the government's increasing tendency to actively select favored industries and companies, providing them with substantial financial backing and now direct ownership stakes. This practice, once a hallmark of policies that conservatives traditionally opposed, is seen as a distortion of free market principles. Furthermore, the inherent conflict of interest arising when the government acts as both a regulator and a shareholder is a major point of contention. The critical question looms: will Washington regulate Intel with the same rigor as its competitors, or will its shareholder status lead to preferential treatment? The answer, many suggest, is uncomfortably obvious. The Intel deal, however, is being framed by some policymakers not as an isolated event, but as a potential down payment toward the establishment of a U.S. sovereign wealth fund. National Economic Council Director Kevin Hassett has publicly alluded to the prevalence of such funds globally, suggesting that the Intel stake aligns America with this international trend. This proposition, however, faces strong opposition. While over 90 countries operate sovereign wealth funds, their success is often tied to specific economic environments. Many are found in undemocratic nations or in resource-rich countries with consistent budget surpluses, often derived from oil and gas revenues. Norway, for instance, boasts the world's largest fund, supported by surpluses averaging nearly 10% of its GDP over the past 15 years. Singapore, another frequently cited example, maintains an average fiscal surplus of 3.6%, while the UAE posts surpluses around 3%. The United States, in stark contrast, operates under a different fiscal reality. The nation has consistently run average deficits of 7% of its GDP over the same period, with gross U.S. debt reaching approximately $37 trillion. Projections indicate a potential addition of $116 trillion over the next 3 decades if entitlement programs remain unreformed. Proposing to borrow even more funds to engage in investment management, given this fiscal backdrop, is viewed by many as sheer economic recklessness. The argument that the government can exploit a free money arbitrage by borrowing at low risk-free rates and investing at higher market rates is fundamentally flawed. Interest rates are not static. They rise when debt levels become unsustainable, a situation increasingly applicable to the U.S. fiscal outlook. Moreover, private investors are already actively pursuing such opportunities, indicating no shortage of capital in the U.S. market. Government intervention in this space would likely do little more than displace private investment, leaving taxpayers to bear both the inherent risks and the mounting debt. Sovereign wealth funds are inherently political entities. Unlike private investors, governments are not subject to the same market discipline of profit and loss. As a former presidential candidate once cautioned, such funds can be motivated by more than just market considerations. Their investment portfolios can easily become arenas for lobbying, regulatory capture, and ideological agendas, as evidenced by instances in Australia, New Zealand, and South Korea, where funds have been steered toward politically expedient projects or reshaped by bureaucratic infighting. The politicization of invested capital, regardless of the fund's structure, is a significant risk. An American SWF could institutionalize rent-seeking behaviors on an unprecedented scale, with Washington dictating which industries receive support. This could warp policy decisions on everything from energy and technology to labor standards and foreign relations, all influenced by the government's financial interests. The temptation to manipulate regulations to protect its investments would be immense. For those on the right who believe their values would guide such a fund, history suggests that political power is transient, and future administrations might hold vastly different priorities. But what happens when this government involvement intersects with the complex world of corporate leadership and strategic shifts? Stay tuned as we explore the evolving landscape of the semiconductor industry and the key players vying for dominance. Intel's bold comeback play: can new leadership spark a stock surge? The semiconductor industry is a relentless arena of innovation and intense competition, and Intel, a long-standing titan, finds itself at a pivotal juncture. Under the guidance of its new CEO, Lip-Bu Tan, the company is embarking on a strategic turnaround, aiming to reclaim its former glory and capitalize on the burgeoning demand for advanced chips. This shift has naturally led to a critical question for investors: is now the opportune moment to invest in Intel's potential resurgence? The global demand for semiconductors, particularly those powering artificial intelligence and data centers, continues to surge, creating both immense opportunities and significant challenges for industry leaders. Geopolitical tensions, including trade conflicts between the U.S. and China, along with fluctuating tariff policies, add layers of complexity to the market dynamics. Amidst this, the U.S. government's proactive stance in promoting domestic semiconductor production aims to reduce reliance on foreign supply chains, directly impacting major players like Nvidia, AMD, and, of course, Intel. Each company is charting its own course to capture the growth fueled by AI, but Wall Street analysts remain divided on which stock presents the most compelling investment case. Nvidia has firmly established itself as the undisputed leader in the AI chip market. Its recent financial reports have showcased exceptional performance, exceeding expectations in both revenue and earnings. While investors initially expressed some concern over a perceived slowdown in data center revenue growth, the segment still delivered a robust 56% year-over-year increase. Nvidia's overall outlook, driven by AI, remains significantly ahead of its competitors. The company anticipates a staggering $3 trillion to $4 trillion in AI infrastructure spending by 2030, positioning itself as a central figure in this technological revolution. Analysts like Ruben Roy from Stifel have reiterated a buy rating, setting a price target of $212 and projecting a positive third quarter with $54 billion in revenue, largely propelled by its data center segment. The broader sentiment on Wall Street towards Nvidia is overwhelmingly positive, with a consensus of 35 buy ratings, 3 holds, and a single sell. The average price target stands at $211.14, suggesting a potential upside of 23.8%. Year-to-date, Nvidia has already seen a 27% increase, solidifying its status as investors' preferred choice. Intel, meanwhile, has recently experienced an upward trend in its stock price, largely attributed to substantial investments. The U.S. government has injected $5.7 billion into the company, complemented by an additional $2 billion from SoftBank. These financial infusions underscore the administration's commitment to revitalizing domestic semiconductor manufacturing capabilities. Intel's stock has climbed approximately 20% since the beginning of the year, demonstrating strong performance, particularly in the last month. Despite this positive momentum, analysts maintain a cautious outlook on Intel. A primary concern is the company's perceived struggle to effectively capitalize on the AI trend, leading to a gradual erosion of market share to its rivals. Joe Moore from Morgan Stanley maintains a hold rating with a price target of $23, citing a lack of strategic clarity, challenges in server leadership, and questions surrounding the long-term viability of its foundry plans as key reasons for his stance. This cautious sentiment is reflected in analyst reports, which show a consensus of 26 hold ratings, 3 sells, and only 1 buy, with an average price target of $22.34, indicating a potential downside of approximately 7% from its current trading price. Intel's turnaround effort appears to be a high-risk endeavor, largely sustained by external financial support rather than organic market demand. In contrast, Advanced Micro Devices, AMD, has seen a remarkable 34% surge since the start of 2025. This growth is fueled by optimistic projections for its upcoming AI chip releases and the persistent demand for inference-based products. While Nvidia dominates the AI training segment, AMD is making significant inroads in inference with its MI355 chip and MI400 GPUs, alongside continued demand for its EPYC server processors. William Stein of Truist Securities recently upgraded AMD from neutral to buy with a price target of $213, noting a significant shift in perception among large data center users. AMD is no longer just a backup option. It is now being considered a viable partner for major AI projects. Wall Street generally holds a buy consensus for AMD, with 25 buy ratings and 10 holds. The average price target of $184.74 suggests a potential upside of 14%. With its growing market credibility and strategic collaborations, AMD has emerged as a formidable challenger to Nvidia. Ultimately, the choice for investors hinges on their risk appetite and market outlook. Nvidia remains the top pick for those seeking certainty and momentum in the AI revolution, despite its premium valuation. AMD presents a compelling option for diversification and a bet on a strong challenger. Intel, on the other hand, serves as a cautionary tale, illustrating the perils of falling behind in innovation, its recovery heavily reliant on external capital and a complex, long-term strategy. The market's decision is clear: Nvidia for leadership, AMD for a dynamic alternative, and Intel for the patient investor willing to bet on a high-risk turnaround story. But amidst these strategic plays and market analyses, political reactions can add unexpected twists to the narrative. Up next, we examine how a prominent political figure is weighing in on a major tech deal and the implications it carries. The political playbook: Senator Warren weighs in on Intel's government deal. In a development that has caught many by surprise, Senator Elizabeth Warren, a known critic of the Trump administration, has offered a somewhat mixed reaction to the recent equity stake deal between chip giant Intel and the U.S. government. Despite the nuanced stance, the market showed little hesitation, with Intel's shares experiencing a modest uptick of over 2% in recent trading. Senator Warren's position on the Intel deal is complex. While she did not outright oppose the concept of the government taking equity stakes in companies, she quickly sought to qualify her remarks. Reports indicate that President Trump may have substituted the equity stake for other stipulations that Intel was expected to adhere to under the CHIPS Act. Senator Warren had previously proposed an amendment to the CHIPS Act that would have mandated equity stakes, in the form of warrants, equity, or senior debt, in exchange for government grants. Her intention was for these equity stakes to be utilized as one of several tools, not as a complete replacement for other regulatory requirements. This distinction prompted her to pen a letter to the Commerce Department, seeking clarification and expressing her specific concerns. The situation takes an interesting turn when considering Intel's subsequent actions. In a move that some might perceive as tone-deaf, given the substantial public investment via the equity stake, Intel joined a coalition of companies involved in establishing a chip plant in India. CEO Lip-Bu Tan is slated to visit India later this year, with plans to attend the groundbreaking ceremony for a new semiconductor plant in Odisha. This facility, owned by 3D Glass Solutions and involving silicon carbide company 6M, is anticipated to commence operations within the next 2 years. Turning to the financial markets, the analyst sentiment surrounding Intel, INTC, remains largely cautious. The stock currently holds a hold consensus rating based on 1 buy, 25 holds, and 3 sell ratings issued within the past 3 months. Despite a notable 23.71% rally in its share price over the last year, the average price target of $22.34 per share suggests a potential downside risk of 9.66%. This indicates that while the stock has performed well recently, Wall Street analysts are not yet convinced of its long-term trajectory, particularly in light of its competitive challenges and the strategic questions surrounding its recovery plan. The broader context of the semiconductor industry remains dynamic, with intense competition and significant government intervention shaping the landscape. While Intel benefits from substantial government backing, its ability to translate these investments into market share gains, particularly in the crucial AI segment, is still under scrutiny. The mixed signals from political figures like Senator Warren, coupled with the company's international expansion efforts, add layers of complexity to its investment profile. Investors are closely watching how Intel navigates these intertwined economic, political, and competitive forces to determine if its current stock performance is sustainable or merely a temporary reaction to external support. But how does this intricate dance between government, industry, and political commentary align, with the broader economic strategies being considered at the highest levels? We'll delve into the potential implications of these government actions on the future of national economic policy in our next segment. Intel's global footprint, from U.S. subsidies to Indian semiconductor plants. In a move that highlights the complex global strategies of semiconductor giants, Intel has recently joined a coalition of companies planning to establish a new chip plant in India. This development comes in the wake of significant U.S. government investment in Intel, including an equity stake and substantial subsidies, creating a fascinating juxtaposition of domestic support and international expansion. The U.S. government's recent equity stake in Intel, announced by President Trump, has been a subject of considerable debate. While framed as a taxpayer benefit, the deal is backed by approximately $8.9 billion in subsidies, raising questions about market distortions and potential conflicts of interest. Critics argue that such government intervention in picking corporate winners and losers can stifle competition and lead to inefficient allocation of resources. The administration's rationale, however, points towards a strategic effort to bolster domestic manufacturing and technological leadership. Amidst this domestic focus, Intel's CEO, Lip-Bu Tan, is scheduled to visit India before the end of the year. His itinerary includes attending the groundbreaking ceremony for a new semiconductor plant in Odisha. This facility is being developed by 3D Glass Solutions, in partnership with silicon carbide company 6M. The plant is projected to begin operations within the next 2 years, signifying a tangible step in expanding semiconductor manufacturing capabilities in India. This international venture by Intel raises several important points. Firstly, it demonstrates the company's commitment to diversifying its manufacturing base and tapping into new markets. Secondly, it aligns with India's own ambitions to become a major hub for electronics manufacturing and semiconductor production. The Indian government has been actively promoting policies to attract foreign investment in the semiconductor sector, recognizing its strategic importance in the global supply chain. However, the timing and nature of Intel's international expansion, particularly its involvement in India while receiving substantial support from the U.S. government, have not gone unnoticed. Some critics might question whether this global strategy is fully aligned with the objectives of the U.S. CHIPS Act, which aims to onshore semiconductor manufacturing and reduce reliance on foreign production. While companies often operate on a global scale, the optics of utilizing domestic subsidies to fund international expansion can be sensitive. Wall Street analysts, meanwhile, maintain a generally cautious outlook on Intel INTC. The stock currently holds a hold consensus rating, reflecting a mix of 1 buy, 25 holds, and 3 sell ratings from the past 3 months. Despite a year-long rally of approximately 23.71%, the average analyst price target of $22.34 suggests a potential downside of nearly 10%. This indicates that while Intel is making strategic moves, its path to sustained profitability and market leadership remains challenging, with analysts closely monitoring its execution and competitive positioning. The interplay between government support, corporate strategy, and global market dynamics is increasingly defining the semiconductor industry. Intel's dual approach, benefiting from U.S. investment while expanding its footprint in India, underscores the complexities and opportunities inherent in this high-stakes sector. The success of these strategies will ultimately be judged by their impact on Intel's financial performance, its competitive standing, and its contribution to the global semiconductor ecosystem. But as these major tech players navigate global markets and government policies, what's the overall sentiment on the street regarding the future of chip stocks? We'll wrap up with a quick look at where analysts are placing their bets for 2025. That's a wrap on another lightning round of critical updates. We've seen the U.S. government dive into tech investments, sparking major economic debates. We've analyzed the intense competition in the AI chip market, with Nvidia leading the charge and AMD gaining ground. We've heard from Senator Warren on the complexities of government tech deals and explored Intel's global expansion amidst domestic support. Don't miss out on future insights. Hit that like button if you found this valuable, subscribe to Qualcomm Pulse for your essential tech and business briefings, and ring that notification bell so you're always in the loop. For more in-depth analysis and to join the conversation, follow us on all our social media channels. We'll see you in the next one.